Hello, welcome to It's Your Smarter Money, hosted by Atlas Fiduciary Financial. Today, we want to talk to you about the bond market. The bond market has been very unusual this year, and so we want to talk to you about what's going on with it, and then explain to you what we're doing to help alleviate some of the pain that people are suffering through. So the first thing that we really wanted to do was show you how an average bond fund is performing. And so the bond fund that we went to was BND. It's a Vanguard fund. And it's something that actually mirrors the Barclay Ag, which is the index around bond funds. And so here you can see this particular fund has done. And year to date, it's down over 14%. Actually, this was a day or two ago. It's down more than 15% this year. And that's very painful because we're looking to our bond portion of our portfolio to be stable. That's the whole reason why we have bonds in the portfolio.
That's right. And so what isn't shown here, of course, is the fact that quite likely this bond fund has experienced redemptions. And that's going to force the fund managers to sell probably the assets that have declined the least. In other words, probably the highest quality assets have been sold, possibly. And additionally, when you have a 14% negative return year to date, assuming a bond yield or the yield in this fund is maybe 3%, argument's sake, it's going to take you, just with simple math, 3 or 4 years to recover your NAV. And you can see now here how horrible the 10-year average return now has been. 10-year annualized, but 0.87% a year. And so anyone who holds this fund, they may never really recover their NAV, at least for a number of years, which is a sad thing. By the way, the Wall Street Journal said probably about 3 or 4 months ago that this was the worst year for the bond market since 1800s, which is quite stunning.
Very much so, especially when you look at when we look at all the risk parameters. We've talked to you about some of them, like standard deviation and so forth. And you compare bonds and this fund compared to stocks and let's say SPY or some type of stock fund. This bond fund has maybe at most a quarter to a third of the amount of risk that a stock would have. And so we don't expect it to be as volatile. And what Steve just mentioned, I do want to, if you don't mind, Steve, just expand a little bit on that component of the fact that bond fund managers are required to sell the bonds. The problem is when people start experiencing this kind of pain, they decide they want to leave. And so they start redeeming money out of the fund. And so the bond fund manager is in a little bit of a conundrum because they have to decide, what am I going to sell? Well, they don't want to sell the items that have really come down and have dragged the value down so much. So they wind up selling the quality bonds just so that they can somewhat keep the performance going. What happens, though, is that they wind up getting stuck with lower non-investment grade or lower quality bonds, and that's a concern.
Also, by the way, in my experience, I've never seen a year like this with bond funds. In my experience,
no,
that's 30 years.
Yeah, and just want to also mention that this particular bond fund, as is a representation of the bond market. It has both government issues as well as corporate issues, and we just pulled the top 10 holdings of this particular fund, which is on the right-hand side of this page, and you can see that the top 10 holdings are treasuries of all things, which is even more concerning that you're in these really supposedly higher quality bonds and just you're being forced to sell out of them at the worst time.
So I haven't examined the quality of the bonds that are held within this particular fund, and we can certainly do that at some point. We can run an analysis on it and see what the ratings are of the corporates. Obviously, government bonds are all rated. There's no real rating. It's considered to be riskless. But we can certainly check that, and we have not checked that. But I have a feeling.
Actually, Steve, I'm so sorry. I have it, and they're all investment grade.
They are investment grade. Okay, thank you.
This fund is investment grade, and that's that's the problem, is that it's not even speculative. You might expect in a speculative market for it to be declining like this, but
So that
we're
means,
talking about quality
A and
investments.
better, generally, A and better,
Mhm.
for the ratings. And so for those types of bonds to be down this much because of the increase we've experienced in interest rates, it's really, that's stunning for somebody who holds this fund. It's
Right. So,
bad.
so the question is, what are we doing, Steve? Because if this is what people are experiencing in an average traditional portfolio, a 60-40 type of portfolio, which is not really what we're in, but we do have a slice of everybody's portfolio, or most of our clients' portfolio, in fixed income.
Right.
What are we doing? Well, first of all, we always take a step back and say, what is the goal of this particular portion? And we know that the goal is, first of all, stability, it's preservation of capital, it's having a reservoir of money for us to pull from whenever we need a cash distribution or other things. And so the question is, what do we do?
Right. And especially in a market, the idea is that was part two of the three bucket idea. The first bucket being your cash, the second bucket being bonds that hopefully hold their value when the market is declining significantly. And that hasn't happened this year with these bond funds. And the third bucket, of course, is the growth. And the idea being that you pull from the bonds if you need more cash to meet your living expense needs. And now if you own this fund, you're going to take a pretty decent loss on some of those withdrawals. So, but what we do in our case is we actually buy individual bonds, which Lori can explain why that's different.
Well, individual bonds we have control over, right? So we're able to buy bonds specifically custom purchased for each person's portfolio. So there are bonds that do different things that might make sense for one client that might not make sense for another client. We are also much more focused, rather than put the corporate bonds in the pile, we tend to stay away from them and stick more with government types of bonds, sovereign debt, because sovereign debt behaves differently. Again, don't forget, we're always looking for investments that have a different source of risk other than the market. So if you buy a corporate bond, well, okay, it's a bond versus a stock, but it's still associated with the same entities. So we tend to stick more with sovereign debt as well. And so when you start looking at how sovereign debt has been performing, you can see that there's been a drastic change year over year. And Steve actually pulled this next chart, which shows the orange line is the rates of the treasuries that are being offered now, 5-year, 10-year. On the x-axis, you can see 15-year, 20-year, 25 years, 30 years. Compare that to the brown line, which is just a year ago. And you can see how much it changed. There's been a drastic change over the year.
Yes. Yeah. And what's interesting also is you look at that top chart, we're experiencing something called an inversion, where the shorter term rates are higher actually than the longer term rates. And that's usually, in the past, has been an indication that we may be going into a recession.
Or even in a recession, right?
Or are we already in one? Yeah. If you go by the statistics, we are actually in one now, which, recession defined as 2 quarters of negative GDP growth.
So treasuries are actually quite interesting right now. And even when we look at the 3-month or the 6-month, especially when people are asking us to do something in terms of they might be needing some cash in the near future, we have been trying to use some of these shorter term treasuries for a cash type of equivalent, but with the yield. For the first time, we're actually getting a yield out of a cash equivalent, which is something that we're trying to take advantage of.
That's pretty obvious from this chart too, because if you look at the yield curve from a year ago, even the 5-year treasury was paying what, well, actually it was 5 years ago, but even I guess 1 year ago it was paying what, 1% maybe.
Right. And anything under that was hardly anything. So there was really no games to be played with that.
No.
Yeah. The other thing that's kind of interesting when we do look at that, I'm sorry, that comparison of the 5-year versus the 20-25 year, For somebody that thinks that inflation is going to start settling down and perhaps going back to its average, 3% has been the average inflation rate, and they don't really need a lot of return, they just need to stay ahead of inflation. Maybe a 20-year treasury with a 4% return is good enough. And so that's actually kind of interesting too. We don't know.
Yeah.
It's 4%. Is it going to go higher, or is it going to start coming down? In which case, 4% could be as good as it gets.
It may be. We have no idea, of course. And, you know, a lot of factors determine that. You know, I think part of it's how effective the Federal Reserve is going to be in wringing out inflation out of the economy right now. And they only have so much control over it. You know, like I think a significant part of the inflation we're experiencing is also energy costs. And the Federal Reserve obviously has no control over that. They can affect demand in the long run by increasing interest rates, which slows down the housing market and various sectors of the economy, but it may take some time for that. That will reduce energy demand possibly, but it may take some time, I think.
Right. And your next chart shows the relationship, right, between inflation and.
Yeah, and so here we have in orange the 10-year Treasury rate, and in purple the annualized CPI or inflation rate. And you can see right now how far below the inflation rate the 10-year Treasury is right now. You know, it's around 3.83%, and inflation's over 8%. And you can see we have experienced that in the past. You know, we go back to the late 70s, but what ended up happening is the 10-year Treasury kept rising. And at some point, it actually did provide a positive return with respect to inflation. So there seemed to be a lag. So will that happen in the future? It's anybody's guess, you know, at this point. But right now, you're actually losing money if you invest in the 10-year Treasury with respect to inflation. And that goes for most bonds right now.
One thing that I do want to mention, without getting into the mechanics of the FOMC, is that when the Federal Reserve raises interest rates, it's really only working with the short end of the curve, not necessarily the long end of the curve. Supply and demand are really what impact the 10-year and further out in the curve.
Yeah, and also traders' anticipation for future inflation rates as well also affect the 10-year and out for the Treasury. In other words, if they think inflation is going to be high, I think you're going to gradually see that increase because they're going to have to get some kind of return on those 10 and 20 and 30-year Treasuries. So, all right.
So Treasuries is one option, and we are using some Treasuries for some clients in certain situations. What's even more interesting, however, are municipal bonds, and especially if you have money in a taxable account, because municipal bonds are not taxed on the federal level. For some cases, if you buy so for example, for our New Jersey folks, if you have New Jersey bonds, you're also not taxed on the state level. But for our Florida folks, we only care about federal tax. And so we can use pretty much any bond throughout the country, and we're going to avoid federal taxes. And so you can see what's so interesting about that, and what's something that you may not fully appreciate what we're doing is we're monitoring your tax return. We're monitoring your marginal bracket. And when we see that we can take this top left-hand box talks about just the raw rate. So for example, for a 5-year, I think that's what Steve, I'm having trouble.
I can read it. The 5-year is for 3.28%.
For a general obligation bond.
And we should explain the difference there. A GO is backed by the full taxing power of an entity, a town or a city, whereas right below it is or above it, I should say, is the rate for revenue bonds. And those are typically backed by the revenue generated by a single project. It could be a stadium, it could be a water project, it could be a sewer project. And so generally the rates are higher for those. But that's a combination. There's some revenue bonds we would never consider buying, but that's another story. But that rate is a little higher. That's 3.5%. And that's before, not counting taxes, by the way.
When you start purchasing revenue bonds, you really need to know what kinds of bonds you're buying, right? But that's the
That's
whole thing
right.
about municipals, is that you do want to make sure that you're buying quality investment grade with solid balance sheets that have somewhat of a guaranteed income stream that they can actually pay their debt.
That's right.
And that's part of the work that we do, along with assistance from some of the bond houses that we work with. But
You also want to make sure it's an essential project, like a water company, or or a sewer facility, something that it's always going to be there. Not unlike a stadium. A stadium could go south. They could have problems with it. The team that is in a stadium could decide to leave. There's a lot of things that can happen, or even a parking garage, things of that nature. So
So what we do though is when we're looking at these bonds, and especially when we're purchasing for them for your taxable account, is we want to know what your total return is going to be. And so we calculate something called the total equivalent yield. And it's basically the yields that you're getting from that bond just flat out, divided by 1 minus your tax bracket. So if you're in a 24% tax bracket, it's 1 minus 24, which is the 0.76. And then that gives us this number, which is 4.32. And that's the actual yield you're experiencing. Now, you might not necessarily fully appreciate that and say, okay, good job, Steve, Laura, you did this for us, because you're not always looking at your investments along with your tax return. But we're very, from a comprehensive standpoint, we think that this is very important.
Yep.
And it starts making these municipals extremely competitive.
Yep, it does. And so if you're in a 37% tax bracket, if you look at the 5-year, the tax equivalent yield on GOs is 5.2%, which is that's a really good yield.
And so most of you, our clients, are holding these bonds. You're holding different versions of these bonds. It may show that the value of these bonds currently is not fully stated at the price that we're expecting to get it at the end of the maturity of these bonds.
Right.
But we're not concerned. And for us, when we see a loss on paper that says, okay, if you sell this bond today, you're going to take a loss, we know we're going to hold it for 2, 3, 4 more years and get the full contractual amount for that bond. We're not concerned. These bonds are solid bonds, and they will give us a return.
And that's the difference between holding individual bonds and owning a mutual fund. You may never fully recover the capital that you've really lost the capital. You haven't sold it, but it's declined in value. And that's very different than a stock fund, which can recover. It's going to be hard for bond funds to recover.
And Steve, you actually brought up the other side of that. What makes it even worse is that now you're sitting in a fund with lower quality bonds in them, which also has increased your risk of your portfolio, and you may not even be aware of that.
That's a really good point. Yep.
So we have an internal strategy for selecting bonds. We have a general overall strategy. Of course, there are nuances for each client, but there are things that we've agreed when we do go out and purchase our municipal bonds, what we want to achieve.
Yep.
And so this just kind of talks to the overall strategy that we're looking for. Fixed coupon municipal debt. We're looking for moderate liquidity, but investment grade, always investment grade.
Always.
Usually, lately we've been more in that intermediate space, but that sometimes can change depending upon how things go. In terms of the objective, you can see the objective here. Really, that we're looking for that tax-free income. And maintaining preservation of capital and maintaining the risk of the overall portfolio. And then we have some constraints as well, where how if we're buying a secondary piece on the market, which is not a new issuance, but something that somebody else has owned and they're selling that piece, we want to make sure that it has at least 12 months of maturity on it. We don't want to go past 15 years, We want to look at the ratings from Moody's and Ford's. We want to look at the overall exposure to that entity and limit that in terms of the amount of bonds we would hold in any single institution.
Right.
Yeah, we're careful with the allocation to revenue bonds, and we want to make sure we're also very particular about the revenue bonds that we use. And so these are the types of things that we're thinking about, and we're talking to, again, when we're using these different bond houses to purchase a bond, these are the types of things that are being considered.
And by the way, municipal bonds have historically had a really low default rate. So I think we're going to talk about that a little bit too. Historically, much lower than corporates. In fact, it's not even close, the default rate.
This really just is a lot of what was just said on the prior chart in pictures in terms of our risk parameters and the overall summary of what we're looking for in our bonds.
Yep. And we try to diversify by region, you know, as much as possible, although I will tell you, region and sector, but we don't have to be as concerned with diversification with municipals because they've had such a low default rate historically. Whereas with corporate bonds, you always got to be concerned with diversification. I don't care, even if you have the highest credit quality, because they're more apt to be subject to credit quality lowered ratings, which lowers the value of the bond. You know, Moody's might say at AAA, some of the companies starting to experience issues, so they may downgrade them, you know, into an A or even a triple B. And what that does, even if you haven't sold the bond, it affects the value of the bond. You know, your municipals, we seldom ever see that,
Right?
Especially with the municipals we purchased. So,
Although
I want to mention we avoid certain states too.
Yeah.
Certain states were concerned with with their financial circumstance. Illinois is one, you know, quite honestly, New Jersey is another one, in California. 3 states we generally don't really purchase a lot of bonds issued by municipalities in those 3 states. So,
and it's a shame because the New Jersey folks probably would love to have the New Jersey piece for the state, but you have to weigh the benefits of the tax benefit versus the exposure.
That's right.
You mentioned Illinois. I mean, they've had some difficulties. The other one state that's had a lot of difficulty, if you call it a state, is Puerto Rico.
I was going to mention that. Yep.
Yeah.
So the good part about them is, you know, they were in trouble for a long time, so you could get out. And that's the other times. These things start to decay a lot more slowly than a corporation when they start to decay. You know, you see it less quickly with a municipality than you do with a corporation. Corporation, you can
troubles hit the fan around 2016, I think, was really started really having major problems.
Yep, that's right. And so here's just, I guess you just have the default frequency, number of defaults. This doesn't really show the rate. It shows the number of defaults, and it is pretty low. You know, even in 04, you saw maybe 14.
Tiny. It's tiny. Although over the past 10 years, it has increased. There was the 2004 to like 2008. A lot of those defaults are housing related to housing projects.
Right.
In 2020,
which we avoid, by the way. We avoid housing projects.
Right. For that reason, right?
Yeah, exactly.
2020, we saw 2 defaults. Both of them had nothing to do with the pandemic, but one of them was, I think, the New Orleans Archdiocese, and I can't remember the other one. But you know, we're definitely aware of what's going on, and these tend to be more speculative in nature. You know, Steve was comparing that, you know, defaults of municipals versus corporates. I think municipals are something like 0.08%, and corporates are somewhere in the neighborhood of 7%. It's a big difference. And so when you're buying individual corporate bonds, you have to be careful. But if you're staying in the investment grade municipalities, I'm not going to say never. And so you have to be careful. And it's nice to have somebody like have our firm being, you know, with a little bit more knowledge, working on buying these things for you, because we try to be very, everybody knows we tend to be conservative and cautious.
Very.
So we're watching out for that. And we've never had a bond default. Steve, in all your years, have you ever had, because you've been buying bonds, we've been buying bonds, both of us.
20 years.
Yeah.
Never have in default ever.
Yeah. So we're your bond fund manager in essence. So instead of having a bond fund manager that's managing your Vanguard bond fund or any bond, we're your bond fund manager. And
That's right.
by the way, you're not only are you benefiting from that by the nature of the fact that you have individual bonds versus a bond fund, but you're benefiting from that based upon the fact that they are custom bonds purchased for you and only for you. We don't buy big swaths and then divvy them out into people's portfolios.
Yep.
We buy a bond with you in mind and your needs and your tax bracket and everything. Where are we putting it? Are we putting it in your tax deferred or your taxable account? But the other side of it is there's no expense. Your
That's
expense
right.
is absorbed in our fee. So that's another kind of aspect of a place where our fee isn't as it's kind of minimized because of that.
The only
that
cost
opportunity.
is the slight markup that comes from the bond houses we purchased from, and it's very slight. It's like 10 basis points in that range, which because we get institutional class pricing, and that's a one
Steve,
time, by the way.
those markups are really in all the bond house.
Yep.
That's actually embedded in the bond funds as well.
Yep,
Truthfully,
it
so
is.
it's not.
Yep. Good point. Yep.
Yeah,
And keep in mind, if you're holding a bond for 5 years, it's 0.02%, 0.02 basis points a year. So it's tiny. And we do monitor that, by the way, as well. The houses we work with, they send us something called the transparency report, which shows us what the markup has been on the bonds they purchase. So we know, and we monitor that, and we make sure that those costs remain low.
And they're usually much better priced than anything you could buy from on the retail market.
Oh yeah. Yep.
Because of the institutional nature. So I think that's most of what we wanted to talk to you about. What's going on in the bond market, particularly right now. In this following this third quarter, we're now seeing bonds becoming more and more attractive, and so there are some strategies that we're trying to employ. And we can talk to you about your individual portfolio. One thing that I wanted to mention, and we actually talked about whether we were going to do a whole video on this, but it might not make sense to do a whole video on this, is that people are continuing to ask about I bonds. And just want to say that there are people out there, some of the financial gurus, if you will, I won't mention names, who think that everybody should have an I bond. And first of all, anytime anybody says everybody should do anything, you should question that. Everybody should not have I bonds. I bonds have a lot. They have some upsides, but they have downsides as well. And when you start weighing out the downsides of the I bonds, the lack of liquidity, the lack of transparency, the lack of reporting, the potential of losing that money altogether because you're not getting ongoing performing, the fact that you have to manage it yourself and go into treasury direct yourself, which is a very cumbersome process, and that the actual amount that you can even invest is so low. You take that and you take into account the fact that a blended rate for a year minus any penalties, and you compare that to a municipal with a tax advantage, and you're starting to get to the place where it's not as interesting as you might first think it is.
Especially if the inflation does come down, if the inflation, because their return is based very heavily on the inflation rate, the CPI.
Absolutely. But right now, just so you know, you're going to hear a wave over the next couple of days, probably, of I bonds, because when the on the 13th of this month, which is in a couple of days or so,
Thursday,
the CPI is going to come out, and people are going to start speculating on what the rate of the I bond is going to be for the next 6 months. And so you can almost buy an I bond prior to November 1st with knowing exactly the rate you're going to be walking into. And I'm not saying that this isn't a good idea for some people. If you have $10,000 outside of your overall strategy and you're interested in doing something like that and you want to talk more about it, we're happy to talk about it. It's just not always as interesting as some people might think at first blush.
Yep.
So thank you for listening to us. And again, if you have questions about I-bonds, municipals, treasuries, or anything else, please feel free to give us a call. And please continue to watch our videos. Even consider liking our videos, because if you like our videos, our understanding is that it does help elevate the exposure that other people get to them as well. So thank you, and we'll see you soon.